Morning, everyone. I hope you are doing fantastically well this morning. 2021 has begun. There we go, Christo. And there you are in a lovely seaside resort. Isn't it wonderful if you can run your business from Seychelles? I'm going to ask you, in order to make this a warm, meaningful, engaging, fun event, please, won't you put your cameras on? I would love to see real people. Mario, look at you. That is a beautiful, beautiful frame you have. You look good. You look professional. You look like you're out there to kill it this year and make things happen. Lloyd, you too. Nice big calendar behind you. I hope all of those grayed out areas on the calendar behind you are deals to be done. Because if there are, we're going to be talking about how to fund those deals. Ashley, nice to see you in the office. Of course, there's business to be done. And John, always on the move, the entrepreneur on the move. And I like the entrepreneur on the move handshake. That's fantastic. Pumelela, I'd love to see what you look like. And Brittany, that's a very nice photograph, but the real thing's obviously better. Sean Cooley, it's so good to see you. I hope you're well. I saw your message. I hope it's nothing. I hope you're well and healthy and strong, because you've got way too much on your plate to let anything get in the way. So welcome this morning. I look forward to talking to you. We're going to be talking about funding. We're going to be talking about how to use funding to make things happen in your business. And I'm going to be running through a very, very short presentation with the view to open up for questions. Richard, you're also looking good. Spectrometry is obviously a good business. I can see that. Fantastic. Let's get going. Why do you do what you do? And you're welcome to answer on chat. Neville, you look very serious. You look like you have a mission behind you. Why do you do what you do? You know, many of us might have found ourselves in business out of necessity, and some of us out of opportunity. And some of us, and I'm guessing Richard Majewski, you one of these people, out of sheer bloody mindedness around a fascination with science. And that's what you want to do to give your life meaning and value. There are lots of reasons, and let's call that the passion of why we do what we do. But ultimately, surely what we should be thinking about is our purpose would be to build an asset. If you think about it, we are the single biggest investors in our own businesses. By far, most of us, 99%, built our businesses without any support from funding anywhere. It was built out of necessity. Sean Cooley will tell you, in his business, he got his first deal serving the mining sector and energy and oil and gas sector on kilometer 8,002. That's how many trips it took. That's passion driving you. And passion's important because it is the fuel. But the purpose has to be to build a business into an asset. And if you think about a stock exchange and you buy a share on the stock exchange, let's say you put 100 Rand into buying a share on the stock exchange. You want three things to come out of it. The first thing you want is capital growth. Should you sell the share in 5 years' time, you want the 100 Rand to turn into at least 200-300 Rand. The difference between the two is your capital growth. In many ways, you did not much to get that capital growth. You simply invested in a good share that knew how to grow its value beyond the dividend stream, which is the second thing you look for, income growth. If you buy the share for 100 Rand, 5 years from now, you sell it for 200 Rand. Over 5 years, hopefully you get dividends of 10 Rand a year. you've got capital growth, you've got income growth. That is a great, great return. But the third feature of that share is that it needs to be tradable. It needs to be sold. It needs to be designed in such a way that you can trade it and sell it without you being involved. Because if you can't sell it, the only thing you can hope for is income growth. The capital growth will never, ever happen. And 94.6% of businesses started globally fail to sell because they're not built into assets. Working with us, we're solving that problem alongside with you, and we call that an asset of value. This is a business that has a brand. The word brand largely means beyond you. If you truly, truly think about its value, it's where someone recognizes the business before they recognize you as a personality or as the proximate cause of the business itself. The word brand is also an experience that customers and clients enjoy from the business, not you. This idea that you hold the relationships makes your business untradeable. So we work hard with you to make the business hold the relationships as opposed to you holding the relationships. It's a progression that we're all going through together. We do that by understanding who we serve. We then build a system of delivery, and all of you are in the thick of systems with us. It's a real grind, but not, because if you understand what the systems do, when they built right and work together, they bring the brand to life without you. And then you have a team who operate the systems to bring the brand to life. And if you think about that, folks, getting that right, understanding what your brand should be, building systems to deliver on the brand, and getting a team to empower the systems is what gives you organic growth. In many ways, your hand in driving revenues at that point in time should be fairly low. And if you weren't at Aurik, you could go and play golf or paint watercolors or learn to make sourdough bread. But because we have an agreement with each other that we're going to build a sellable entity, the next thing that should happen is that you should focus on next level growth. Growth beyond your organic growth. Growth where you're finding deals to lift the growth significantly. And with those entrenched, we then move to understanding how to embed value in the business. An asset of value, it's our purpose together. So let's just think about the process we are going through with you and what we're doing. If you look at it, we've really embarked on customizing an asset of value growth system with you. The first thing we do is we get our positioning right. Instead of talking about product features or service features, we talk about different types of customers, the problems they have, and how to solve them through a good experience. It's what makes you valuable and special in the eyes of your customer. Once you've understood that, we then go through the build phase. And the build phase is all about turning marketing into a system of lead generation. Activities in a sequence that can be measured that generate new leads. Sales into a system of lead conversion. Operations, finance, people into a system of fulfillment to your leads. Because once you have your commercial systems built to serve your promise in your position with the market, you're then in a position where you can get the right people on board to do the right thing at the right time. We've spoken about this before. In an asset of value, you employ people to operate systems. The systems that will articulate and work together to deliver on your positioning, largely without your hand. From there, we move into the growth phase. And this is where we have scale. This represents scale. And this is where we look for deals such as acquisitions of new businesses, acquiring new markets, exports, or alternatively innovating in order to meet new demands in the marketplace. When I speak about spectrometry, Richard, incidentally, I'm talking extensively about how, with the advent of drones, the requirement to create small payload spectrometers has increased dramatically. It's a market that we never had 5-7 years ago. So with drones becoming popular, it opens new doors. And as new technologies become available, so too do new markets evolve and develop. So just hold on to this thought of how we work with you to build an asset of value. Because now we're going to talk about when you need to do what you need to do to grow a business of significant value. If you think about it, every business, like a child, starts as a newborn or an infant or a toddler. Typically, the first anywhere between 7 to 12 years, and it varies from person to person, from team to team, from sector to sector, from industry to industry, and from economic cycle to economic cycle. There are many, many variables. But on average, it takes about 12 years, 7 to 12 years to get out the starting blocks. In the very beginning, it's all about cash flow and sales to get income in. And once you have got some regular income coming in, that's when you need the discipline to position your business and agree that you're not trying to serve everyone all the time, anywhere, anyhow. But this is where you start to niche your business around who it is that you're going to be serving. You go through the build phase, you get the right team on board, you go through the growth phase, and then you have to innovate. In order to remain ahead, you constantly innovate. And innovation isn't about being clever. Honestly, it's not. There's a very, very simple way to innovate. And the best way to innovate is to go back to your customers and say, what's changed in your life? Since I started working with you 12 years ago, 10 years ago, 7 years ago, 5 years ago, what's changed? What can we do better? How can we create a better experience? And innovation is where you do things differently in the build with your team and how you grow in order to serve your customers better and ensure that the experience they have of you remains at a peak. This process will get you anywhere between 7 to 15 million rands worth of revenue. If it's done right and if it's done systematically, this is about building a system of organic growth. This is about building the bones in the body of the athlete called your business. We need a good bone structure. At this point in time, when you've achieved this or reached this, as a business leader, you need to change your focus and change your direction and leadership in the business. Because on the back of a good foundation, no different to a building, if the foundation is strong, we can build the next level. And the next level is now about dominating your segment. If you're clear on who it is you're serving, and it's not everyone, but it's a very well-defined group of customers, 2 or 3 groups of customers, and you've understood them well, and you've built a business that feeds their requirements on an organic basis, this is where you double down to dominate that customer segment in your chosen service or product. You want to become, in the second phase of your value journey, the leader from a brand point of view in that segment. This process takes anywhere between 7 to 9 years. Typically, you're building off the foundation that you have over here. This is all about ramping up marketing and ensuring that you maintain the scale in the business. In other words, the ability of the business, the build, the system of delivery and the team to deliver on your promises, because you're getting bigger deals on board over here. And this will take you anywhere to between 15 to 30 million rand. More or less, again, varying on industry, on sector, on economic cycle, on yourself, your team, the start that you had, and the momentum you've gained from the previous phase. From there, once we have this in play, we then move to the third phase, And the third phase is where we accelerate growth. This is where we start to look for some small acquisitions, where we're buying weaker competitors. So for those of you in the industrial market, it might be where you're acquiring plant and equipment for a few cents in the rand, in that you've identified and you've spotted failing competitors. It might be breaching into new markets. It might be exporting. It might be adding new products or adjusting new services. But the focus over here is where you accelerate growth. This was about building good bones. This was about building muscle on those bones. And this is about giving lots of oxygen into the business so that the business can sprint. In this period, anywhere between 5 to 7 years, you're moving anywhere to around 30 to 60 to 80 odd million rands a year. And if you look at it, most of us spend 15, 20, 30, 35, 40 years building our businesses. And when it comes to exiting them, historically, and I can tell you this from 3.5 years as a business broker, historically, people spend between 30 to 60 hours exiting their businesses. The last stage, the fourth stage, is all around deepening your value. Over here, you have funded your business, producing low profits all the way through, making sure that instead of generating profits, you've been reinvesting back into the business. In the final stage over here, this is where we start to let the profits show. And we need to grow our earnings before interest, depreciation, and tax. In other words, your net profit numbers. Because if you build the business that way, and you can show growth in your last 3 to 5 years, whilst you're enjoying the benefit of accelerated growth to get you from 60 to 120 million rands, the earnings multiple that you will be able to secure when you choose to exit the business will be at a peak, it'll be at a high, it'll be at a premium point. And folks, you know what? We never shown this. We never shown this. I had, depending on how you see it, the fortune or misfortune of being at business school. And this cycle was never shown. It was never shown. From an Aurik point of view, we learned this through direct experience. And for those of you who have read Sweat Scale Sell, we also learned it through the story of Jack the Baker, the very first client that we ever had. These cycles differ in their length, and these cycles face very separate challenges as you progress from 1 to 2 to 3 to 4. It's never too late to, if you find yourself in any one of these cycles, revert back to the process, the system of an asset of value in order to build the strategy to get through the cycle successfully and in a very different time period. What we do with you at Aurik is we shorten all these time periods quite dramatically. So if we're clear on why we do what we do, in other words, our purpose is to build an asset of value, and we have a system of how to do it, and we have a mindset on how to lead the creation of our value, then let's talk about the process of innovation. Because the innovation, as you can see, leads on to the beginning of the next stage in every instance. And the second thing that you need is funding through the various stages. The funding gives the oxygen to move from this level to that level, from this level to that level. And as South Africans, we are so unused to raising growth funding because all the banks have offered us in the past is asset-based funding. If you're buying a factory or buying a tractor or buying some equipment, they'll fund a portion of it. The way that banks have funded growth has been through debt funding. And the problem with debt funding, as you all know, is that I get the debt today, and from next month on, I have to start paying the debt back. A capital portion, an interest portion. And yet the problem with funding, if it's growth funding, is I'm taking it to invest it into my business to generate a future return. So if you give me money today to start paying back tomorrow, what have I got to actually invest with certainty and comfort that the purpose of the funding will meet my requirement? As South Africans, we are not used to equity funding. And it's for that reason that we established Aurik Capital. After years and years and years of attempting to work with banks on their own clients, which were joint clients with Aurik, we were constantly left stonewalled when we were trying to raise growth funding. So we established Aurik Capital, and Aurik Capital is an equity funder, and I'll talk through how it works. It was made possible by something called Section 12J, which is a piece of legislation in the Income Tax Act that allows private people like you and me, to invest in a fund of this nature as funders, like we would invest in the stock exchange, but it's not a traded entity, and we would get a tax break for it. And government argued that the world of SMEs, which is all of us, carries a higher risk than the world of listed entities on the stock exchange, which is obvious. And for that reason, if South Africans want to support the growth of SME businesses that are led by driven, future-focused entrepreneurs, let's ease some of their risk concerns by giving them tax breaks. So Section 12J was established, and we've used it in order to raise a fund in Aurik Capital. Aurik Capital is there to serve only Aurik clients. We are there to solve the problem of, when working with you, seeing the growth occurring, seeing that the growth is being held back because of a lack of funding, to, on the back of our relationship, put the funding in place to enable the growth momentum to not be disturbed. It is all about a growth plan that's activated and driven and can be fueled by funding. Let me dig into it a bit more. There are a couple of criteria. We can fund anywhere between 1 and 7 million rands at a time. And for that, because it's an equity fund, it means that in lieu of the funding, we take equity in the business. So if you own the business and you have 1,000 shares and you own the 1,000 shares and funding goes into the business, additional shares would be allocated to Aurik Capital in order to provide Aurik Capital with the return on the investment of funding it's provided in the future. If you think about what an equity fund does, an equity fund says, I'm trading a product. The product is called funding. The way that I'm going to get a return on my funding is I'm going to invest it into a business, and I'm going to hope that in the future, the business size, in other words, the capital of the business will grow. Remember, the share that went from 100 Rand to 200 Rand over 5 years. And whatever share I got in the beginning, I would extract at the end. And with the 100 Rand that I've invested, I would enjoy the benefit of the growth. So an equity fund invests in the equity in the business, and the equity of the business is expected to grow in the eyes of the funder. The application, it's for growth momentum, not growth potential. So when we raised this fund and we went to market, we made a promise to all the funders, which are all individuals out there, that we would be investing in the momentum of growth. Momentum suggests that growth is already in place and it's building and building and building. We're going from one stage to the next, and we need oxygen, is what the business requires. And this becomes the oxygen for it. It's not for the potential of growth, where I have an idea that I want to implement and that idea will demonstrate growth. Growth must already be in evidence, and it must be clear that that growth is highly probable. So for example, if you're looking to acquire plant equipment and stock, and that's going to support the advent of a new product for a new market, already which you are serving, and already for which the demand is exceeding your supply. It's a classic example of where this funding can be useful. If you've built the business well and your positioning is strong, you've got the system of delivery in place, you've got good people operating the systems, and you've moved into the growth part of your cycle, and you turn around and say, to accelerate our growth, we need to bring on software and technology, and you can demonstrate how, or we need to acquire new people. There are going to be many people, talented people in the job, in the marketplace over the course of this year. Or we want to double down on our marketing. We're already serving this market. We know who the market is. We've got a good sense of where to find them. We want to increase access to that market by increasing our marketing spend. Those are elements that no bank will ever fund. And those are elements that this growth fund is aiming to fund. If you're looking to get into new markets and customers, specifically export markets, and you can demonstrate appetite for your product or service, it's a classical environment where this fund will be very, very positively receptive of your idea. The funding, once it goes into the business, remains in place for a period of 5 to 7 years. So in other words, if the business funds you, if Aurik Capital funds the business, and they, let's say, put 5 million rand into the business, after 5 years, and not before, Aurik Capital seeks to exit its equity shares in the business, its shareholding in the business. Because the funders that funded Aurik are expecting a return between 5 to 7 years. And that's a classical cycle of how any fund works. When you raise a fund, you raise it against a mandate, a promise of who you're investing in, for what purpose, and for what period of time. And with that, you make a promise as well to investors that you will strive to yield a good return for them. The investment criteria, Aurik clients only, and typically we start to look to invest in businesses that are doing upwards of 12 to 15 million rand a year, up to 300 million rands a year. The way we do it, incidentally, I'll get into a little bit earlier, removes all apprehension and trepidation. The process of funding can be a massive operational distraction in the business. How do I know? Because I've been distracted many times when I've looked for funding. And that distraction takes you away from the cycle of building an asset of value. It takes you away from the momentum of growth that you've established. I've seen instances where businesses go and are distracted for a period of 6 to 8 months, seeking funding, only to discover the initial requirement for the funding has faded over the 6 to 8 months. We're going to avoid that, and I'll show you how. So the promise we've made to the funders is that we will manage risk and performance in the fund. And we've argued to them, the way that we do that is we only invest in clients that we know. And we know each other. We have an intimate relationship with you, and vice versa. We see what you're doing. We have a customized growth plan in place with you. We see what's working, what's not. We see how we each respond to problems and challenges. And when you invest in private businesses, you're largely investing in the mindset of the business owners more than the business itself. And the reason I say that is because in our world, the world that we face, the world that we live in, and given the size of our businesses, it's how we behave that makes all the difference, rather than having a fantastic product or a fantastic service, solution. We invest in growth. We're working with you. We can see the growth. We can see the momentum coming. So we can argue that very strongly to the investors. Hey, we know this business well. We know how the team behaves. And we've seen where they've come from. And the trend shows to where they are moving and going. And then we argue to the funders that we manage performance and risk actively. The integration facilitation process that we enjoy with you every month using a dashboard is exactly designed to do that. And with those three arguments in place, we were able to raise money from private funders to capitalize the fund. The next question they ask is, okay, well, Aurik Capital, if you invest in these businesses, 5 to 7 years from now, how do we get our money out? You take 5 million rands of our funding, you put it into a business, you earn a minority equity share of 20 or 30% for the 5 million rand. 5 years later, the business has grown. How do you exit the equity? And there are two arguments I put to those funders. The first is the sale of business. Some of you might be looking to exit your businesses entirely. We already have agreements, or rather we've had discussions in amongst some of you that we're looking to build a business that can be exitable in the next 5 to 10 years. And in some cases, we have long-term programs in place that go through those 3 cycles of growth within a 10-year period. And at the end of the 10-year period, in some cases, we've already identified future acquisition partners. So the business is being built for that listed company to acquire that business. In other cases, where, for example, it might be a family business, the equity would be acquired back by the family itself. And we've established relationships with 3 banks in order to raise debt funding to acquire back their equity in the future. Debt funding is cheaper than equity funding in the long term. And once the business has utilized, say, for example, the 5 million rands to get to a level from 30 million rand to 80 million rand, 5 years down the line, the ability to service debt with ease becomes increasingly more viable. It might be that a private buyer chooses to buy the business. It might be, in some cases, we move towards listing the company as a collective. So sale of businesses really can be either through corporate buys, private buying, or IPOs, or the family itself. That's with the buyback of shares. And if it's not family, it might be your management team that are looking to acquire the business from you over a period of time. And the first acquisition they make is the equity owned by Aurik Capital, with subsequent acquisitions over the future years being the equity you own as you then emerge to exit the business over time. So let's talk process very quickly. The application, we have an application. It'll be sent out to you after this. It's very, very simple. It immediately gets you to a yes, no. It takes about 10 minutes to complete. And this falls into the criterion set by the funders. The mandate that they gave Aurik Capital lets us say yes, no, very, very quickly. There are also some restrictions in terms of Section 12J. So for example, all of you who are making cigarettes, we can't fund you. If you are gun runners, it might be a great business, but I'm afraid we can't fund you. Not because of any ethical issues, but it is set by law in terms of Section 12J. If your business exists outside of South Africa, we can't fund you. The tax break was given to South Africans for South African business to improve the South African SME economy. So there are a few restrictions there, but mostly none of you fall into them. From there, we'll have a provisional engagement. And Fatima, if you can wave your hand wildly so everyone can see you, Fatima will have a discussion with you. We will look to see if we can make a difference to the business. We will look to understand the growth that you've identified, to see where we are in our program of action between each other from an Aurik business accelerator and yourselves. And there we will emerge with a proposal. And that proposal really is a term sheet. It talks to what kind of funding can be provided on what terms and conditions. So we agree all of that up front before we go into a whole process of moving into the funding workshop, where you do your valuation on your business and you prepare your investment case. Once that's done, you present the investment case to an Investcom. They're different to the Investcom that you've enjoyed with Aurik. This Investcom looks at two things only: the ability of the business to perform and the risk of that performance. So there are one or two actuaries that sit on there, and mostly they're quite grumpy people who always want to talk about numbers. And then there's some people from Aurik who sit on there, who only see the opportunity that sits in the potential of the business itself. It makes for a very, very interesting debate and engagement. And then finally from there, if it passes through Investcom, the investment is made, and the agreements that we design are based on the proposal, literally word for word, but with some legalese. Guys, I want to end off with one thought. One thought. What you're looking at over here is the last year of the JSE. When I say in 6 months, businesses that invest strongly in growth now will maximize the inevitable market upturn. This was in April 2020. This is February today. No, yesterday, I'm lying. This is February yesterday. Look where we've gone. And here's the irony. Our economy is still not growing. The only segment that is growing are mid-tier SMEs like us. And we're growing for a few reasons. Number one, during this phase over here, we did an enormous amount of resetting our businesses. We then went through a period of rebuilding from May all the way through to September. And most of us have started to get good revenues coming through from September onward. Very large listed businesses did not have the same capability. They're simply too big, too complicated, and carry too much weight. There are two trends that lie ahead of us. The first is that very large businesses in a low growth economy to get growth do two things. The first thing is they're going to outsource more and more services. And we, the SMEs in South Africa, if we have reset and rebuilt our businesses appropriately, will be the beneficiaries of serving those larger businesses. Our revenues will grow. The second thing that will happen is because big listed entities are under pressure to improve earnings per share. In a no-growth economy, for them to embark on moving into new markets or establishing new initiatives, when they've already cut costs through the outsourcing process to a maximum level, the only other option that lies ahead of them is to make acquisitions of aggressively growing small and medium businesses. And in the next 3 to 5 years, the amount of M&A activity, the acquisition activity that will take place between larger businesses into medium and smaller businesses, I think will hit an all-time high. It is a fantastic time to invest now, to build your business into that asset of value, to aggressively move it through those stages, and make yourself ready for acquisitions 5 to 7 years from now. And with that, I'm going to end off and open up for a few questions. I would implore you, if you have not yet, to read both Sweat Scale Cell, which talks to the system, the growth system behind an asset of value. It will make what we're doing with you so much richer and give you so much more insight and meaning to your everyday work with us. And to read Reset, Rebuild, Reignite, which is about gearing up for the economy I've spoken about 5 to 7 years from now. How you go and you tighten your business, make it lean and mean, get profits down to the bottom line so that you can be ready for a great acquisition 5 to 7 to 10 years from now. And with that, I'm going to end the presentation and open the floor for questions.